Raul, we've managed to hold ourselves back for 12 minutes from talking about what's happening in Bitcoin in the crypto space. Obviously, Bitcoin futures linked ETF seems as though it will not be blocked by SEC. What are your thoughts on this, and what's its significance for this space?
Look, it's very good on some level because it gives people access to the space that couldn't get access before or were felt uncomfortable with custodying their own coins. And so that opens it up for the RAAs and all sorts of others. So the amount of investment in play, I mean, I've been flagging this for ages. We knew it was coming. We knew it was coming about now. It's actually come about 3 weeks earlier than I thought it would, but it's here and the flows haven't started yet. But let's talk a little bit about the construction of this thing. This is a futures contract. So why does that matter? Well, the SEC like it because futures are regulated and it's on the CME and it's cleared so you don't have the custody problem. But one of the movements behind crypto was this self-custody, the ability to take control and get rid of middlemen. What the SEC has actually done is create a product that will deviate from the price of Bitcoin because of the futures contract. So it will trade at a premium in bull market and a discount in bear markets, just like the GBTC product does. That opens massive opportunities for hedge funds to arbitrage it. So they would buy the Bitcoin and sell the futures contract, and it settles at the correct price. So they make a fortune out of this. Not only that, but the construct of these ETFs also bring in, you or I could just go to the exchange and buy Bitcoin, right? We're paying the exchange a little bit of money. That's it. Done. We self-custodied it. Nobody else involved. This vehicle means that the arbitrageurs take their slice. The ETF provider takes their slice. The lawyer who set up the fund takes their slice. The administrator, the auditor. I mean, everybody is taking a slice out of your pie. And we've seen this with stuff like the USO contract, the oil one. The futures then trade at massive contangos. And all that happens is you don't get the performance. And everyone says, well, Bitcoin's up 300%, and how come it only made 100%? Yeah, because you've been screwed. If the SEC really cared about looking after investors, they wouldn't allow these futures contract versions. I understand for commodities it's useful, particularly with agricultural commodities, because you can't store them. So a futures contract works, and it's suboptimal, is what it is. But there's no excuse for something physical like this. It's just no excuse. And I think they think they're helping the little guy get access and it's safer. What they've actually done is enriched Wall Street's monumental infrastructure all the way through to make money from it again. And it's just not fair.
Yeah. So what's changed? I mean,
nothing. Nothing. I mean, this is the thing is in the end, Wall Street lines its own pockets. It lobbies government to make sure that its pockets are always lined because it is the middleman. I mean, I've talked about this on this show before, is the reason why the securities laws are in place is also because the middlemen are now the gatekeepers. That basically is what the law is. It has to be a security, you have to do it in this way. And what you're doing is adding middlemen. So, you're not allowed to invest directly in a startup because that would be considered a security. You're breaking the law. But lo and behold, if you buy it through your RAA who's got it approved, really? You're just paying everybody fees. And it's being wrapped up as expertise and we're trying to keep you safe. It's nonsense.
And by the way, all of those middlemen always convince themselves that they're adding some value. It's not a malicious conspiracy. They really believe that they are, in fact, adding value.
And they are, I mean, to be truthful, you're adding value because you're giving people access to this market that wouldn't have access before. But it's wildly suboptimal. And that's the issue I've got with it. I still think it's bullish because in the end, the arbitrageurs buy the underlying tokens. So there is real demand. So it's not like fake demand. This is just a derivative. It's not how it works. It works from arbitrage. So in the end, the tokens get bought, taken off chain. So it works.
But again, those contracts have to be rolled, so you can have the potential for negative roll yield that's going to dramatically eat into the performance and would be dramatically uh, outstripped by the underlying in certain market conditions.
And it will definitely happen, and people will be upset. And where's my money gone? Why has my brother made so much money in Bitcoin and I bought the ETF and I've made less? That's a valid question. Futures are very sophisticated things for people to understand. How is that helping retail investors? Because those same retail investors can't buy a futures contract themselves. Oh no, because they need to be accredited investors or have proven the ability to trade futures and options. But fine, if we stick it in an ETF, which is just holding futures contracts, you suffer everything apart from the inability to meet margin.
Raoul, I mean, there's so much going on. There's a lot happening in the macro space. There's obviously a tremendous amount happening on crypto. Where do you want to start?
The macro space, I see it on Twitter. Everyone's very excited about inflation, blah, blah, blah. Bond yields went up. They came back down again a bit. I still can't get excited. The dollar broke higher, but it's not moving anything dramatically. Bond yields, outside of the screaming and shouting about this is the end of the world of inflation, bond yields don't suggest much yet. I think they could get to 175 in the 10-year, but I still think they're range bound and lower. I still think growth comes lower. We're seeing this huge dichotomy with the Fed forecast and the Atlanta Fed. The Atlanta Fed, I think, currently is like 1.3% GDP growth for this quarter, and the Fed had 7%, as David Rosenberg pointed out, if you impute it. So I still think there's a slowdown. I think you are raising prices on people that cannot raise wages fast enough or will get those wage rises. So you've got negative real earnings, and that's going to lower consumption. So without question, you can't raise the price of oil, natural gas, foodstuffs, rent, and cars and houses, and it not to affect consumption. So I think that forward growth is still low, and I've talked about this for a long time, but these macro trends take ages to play out.
Yeah. WTI crude right now trading at 82.24, and the 10-year yield at 1.574 as we have this conversation, Raoul.
Yeah, and these have been the rate of change is what matters the most. If you raise people's fuel prices very quickly, it tends to be recessionary. Now, I'm not saying that this is a recession coming, but I think next year is a shock to growth. I just don't see a way. People look at the wage growth, but forget that is being offset by the massive number of boomers leaving the labor force. So the labor force participation rate doesn't go up. So what's happening is there's a bunch of people who are going to be living on retirement income and a bunch of people who might get some wage rises if they're lucky. But that basically offsets each other. So I don't see a net demand increase to the economy. And in fact, demand then gets eaten away because of the increase in prices because of the supply shortages. And that doesn't seem to get resolved yet.